Welcome to Get Started Investing. In this podcast, we cover all the basics you need to start your investing journey. Are you joining us for the very first time? Is this the start of your investing journey? Well, before you dive into this episode with us, our feed is designed to go from the very beginning. So we strongly recommend that you scroll up and start at episode 1. But of course, if you are feeling brave and want to just dive in, don't let us stop you. Here at GSI, we unpack all the jargon and the confusing bits. We hear your investing stories with the goal of making investing less intimidating, and we want to have a good time along the way. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be with you for another episode. I should say, in the very long intro, you say scroll back to the start. I think this episode in particular will be relevant for people who are at the very beginning of their investing journey, because we've been speaking to a number of beginner investors recently, those that are just getting started or maybe haven't even got started yet but want to. And it got us thinking about what we were like when we were beginner investors.
Yeah, well, in the grand scheme of things, that wasn't too long ago.
Well, for me, it wasn't too long ago. I'm still in my 20s and I started investing in my 20s.
Barely holding on.
You do the maths. For you, I mean...
Half my life.
You started investing when you were what? 6?
No, a bit older. Yeah, about 12 or 15 or something.
But for this episode, we're going to say, we've called it 3 things we wish we knew when we were getting started.
Yeah.
We're not going to make you put yourself in the mind of 12-year-old Bryce Lesky.
No.
That's probably a dangerous place to be. But we're going to think about, when we were living together in Canberra, when I was learning about investing, when we were both trying to figure it out, what we wish we knew. And it's not going to be the generic stuff.
Yeah, I was just going to say, we've done stuff like this before, and it's the whole, it's easier than you think, and all those ones. You don't need a lot of money.
ETFs exist. Don't invest in Slater and Gordon and lose your money. We've covered that.
We've covered that ground, yeah. So we've got 3, and they're going beyond the cliche ones. And there's nothing wrong with all of those examples that we gave. They are all things that we did wish we knew. But we're going to jump in. So, Ren, before we crack into the 3, there is some housekeeping and a reminder that there is plenty to listen to in the Equity Mates Media Network. We've got You're in Good Company, Comedian v Economist, Talk Money to Me, Crypto Curious, Equity Mates Investing Podcast, of course, and the late Meet, Pay, Love, and the latest show, The Dive, Ren.
That's it. 3 times a week, we will be bringing you one big news story, one business news story, broken down, no jargon, well explained, with a bit of fun along the way. So head over to The Dive, head over to any of those shows. There's plenty of content coming out. But Bryce, let's get into this episode. What are the 3 things that we wish we knew? The
first one is that you don't have to pick a side. The second is the difference between right and wrong isn't the difference between making and losing money. Looking forward to unpacking this one. And the third is to invest, you don't have to be an investor.
Nice.
So some ones that we have...
That's the episode. Thanks for listening.
Thanks for listening. So let's start with the top one, Ren, and that is you don't have to pick a side.
If the media was to be believed,
yes,
investing is a very adversarial game.
Meaning?
Bull versus bear, value versus growth, active v passive, Bryce v Ren, chess v custodial, ethical v non-ethical. Do you believe in Bitcoin or not? Yeah. Is value investing dead or not? Everything is so binary in investing and everything is so adversarial. There's so much conflict. And it's like, as a young investor, I got swept up in that. And I think a lot of investors do. What of all of these debates, of all of these issues, I need to understand it and then I need to decide what side I'm on. And you don't.
No. You don't have to be a value or a growth investor. You can be both.
Yeah.
Yeah.
You don't have to choose active or passive. You can take both.
Yeah. And I think we've spoken to plenty of experts along the way who have a bias towards one, but definitely encompass values and strategies from many of the different types of investing. And I think about one we spoke on Equity Mates a couple of weeks ago, and he was a value investor, but speaking about some of the growth stocks that we've all been investing in over the last 5 years. So trying to pigeonhole yourself into one or the other early on and trying to understand it, it's too overwhelming and unnecessary.
Yeah, the unnecessary point is the important one there, because it feels like a lot of these things are debates that you have to understand and get to the right answer to then really be an investor. And especially for me, thinking back to those early days when we were living in Canberra, value v growth for me was one that I spent a lot of mental energy, looking back, unnecessary mental energy, trying to figure out which side of the debate was right. You'd be reading books about Warren Buffett's early days and value investing and trying to buy a stock for less than it was worth, and then you'd read about growth investors, and you'd come across people that were early on tech and stuff like that, and you'd be like, oh, well, what's the next growth industry? And I remember at that time we were then looking at like China and the Blackmores and the A2 milks that were like these big growth stories in Australia, and there were these two conflicting philosophies, and I think I spent a lot of that time trying to figure out what was the right one and where I sat on it. And looking back, it's like there's merit to both, and you don't have to figure out where you sit on all these debates, because a lot of these debates are kind of sideshows to what really matters.
Yeah, exactly. You just want to make cash. It doesn't matter how it's made, I think. Anyway, I completely agree. Early on, I was very influenced by Buffett. And then there was the Joel Greenblatt book that we read, and a bunch of other books that sort of try and talk you through their process. But there's so much more that goes into it than what they write in a book. And so even just doing a filter or a screen online and finding companies that do match a bunch of ratios, it's kind of like, then what?
Yeah.
So yeah, you don't have to pick a side.
And I think, today in our Facebook group, Chess v Custodial gets a massive... a lot of people expend a lot of energy having that argument in our Facebook group and beyond. That isn't what matters.
No.
Make a decision that's right for you and then move on and focus on what matters. You don't have to pick a side in every debate in finance.
Well, I guess quickly to close this one out, what if someone's sitting there feeling like they're in this moment right now and reading value versus growth and trying to understand which is best for them? What is the way out of this? Like what would, if we were to have our time again, how would we avoid this?
I think, and this is easy to say and hard to do, but it's like, think about what matters. All you are trying to do is make investments that will make you cash, as you eloquently said. And so it's like, there's clearly, like, you can look at professional investors and you can see that people have made money from both value and growth, or you can look at the active investing v passive investing debate, and you can look at that and you see, well, people have made money in both ways. And so really, like, that's not a variable that will determine whether you make money or not.
Yeah, agreed. I think it's just keep a very open mind and don't feel like you need to pigeonhole.
Yeah. And like, it's easy for us to say with hindsight. I don't know if we would have got through to 21-year-old Bryce and Alec, but
well, that's why we're doing this.
Yeah.
We're trying to help all of those out there. So the second one, Ren, is the difference between right and wrong isn't the difference between making and losing money. So let's unpack the first half. The difference between right and wrong in terms of what? A right and wrong investment thesis?
Yeah. Like, is this going to be a good investment, or, is this asset class going to do better than this one? Is property going to do better than stocks? Is bonds going to do better than gold? Or, is a particular company going to do well?
Yeah.
I would, when I started investing, it was like, I thought I had to be right, and if I wasn't right, I would lose money.
Yes.
But what I've subsequently learned is that historically, and history isn't a guarantee of future, but historically, most investment assets have had a bias for going up.
Yes.
So you look at the property market, you look at the stock market, you look at the price of gold, you look at, like, just because of, there's a bunch of reasons why, but the economy gets more productive, people have more money, inflation, like, assets have a bias that trend upwards over time.
Yep.
And when you read about investors being right or wrong, that doesn't mean that they made or lose money. It generally means, did they outperform the average or not?
Yeah.
And in the stock market, the average has been like 7 or 8% a year. For Australia's property market, the average has probably been like, I don't know, 30% a year
Too
or
much.
something.
Too much.
And so I guess what I've learned over time is that plenty of people that are wrong still make money. And they may not make as much money as they don't make as much money as they would have made. They don't make as much money as the average person made. But a lot of times they make more money than they would have got from their 0.25% interest in their savings account.
Yeah.
And, we've spoken to some of the guys from Magellan on Equity Mates Investing before, and they've been criticized a lot in the media for, I guess, being wrong on China, amongst a few things.
Yeah.
But them being wrong, they still earn like 9% returns a year.
Yeah.
That's being catastrophically wrong in the investing game.
Yeah. So to give it a clear example, it's like you're saying, if you were to make a bet on Uber or Lyft being the number one passenger carrier or whatever they are, ride share, and you've taken the bet on Lyft, both could go up in price. But Lyft might not perform anywhere near as well as Uber and not perform as well as the market. You've still made money.
Yeah.
But it's...
tough example because both of those stocks are down a lot.
Yeah, they are. They're both fun. But you know what I mean. Like, you didn't choose the winning horse, but you haven't lost money on the Lyft investment.
Yeah.
Well, you have in reality.
Yeah.
But you know what I mean.
That's probably the second part of this, is that you definitely can lose money. Like Slater and Gordon, I was wrong, and I lost all of my money.
Yeah.
Yeah. But
it's not a black or white as if you're wrong, you lose out.
It's not the same.
Yeah.
Yeah. And if you buy a house in the wrong suburb, or if you bought a house in the wrong suburb in Australia in the last 15 years, chances are that rising tide still lifted your boat, even though other boats were lifted on a tidal wave a lot more. So yeah, I think for me, it's been a big learning that just investment markets have a bias to trend upwards over time. And that's why passive investing works. That's why you can just index invest and it just ticks along in the background. Yeah,
one of my biggest sort of learnings from this was understanding the benchmark, and that everything is measured against that market return, not to zero, as you said, and then feeling comfortable then that actually taking that market return and the benchmark is just absolutely fine.
Yeah.
And it's incredibly hard to outperform over a long period.
I think a simpler way to label this rule would have been the average isn't zero.
Yes.
Yeah.
Yeah.
Like the average is still heading in the right direction.
Yeah. It's really good. The return, an average return.
Yeah.
Over a long period of time.
They shouldn't call it the average return. I guess that's why they call it benchmark sometimes.
True. Yeah.
Because average, it's like, especially in Australia, it's got like a negative connotation. It's like, I feel pretty average.
It's pretty average. Yeah.
Yeah. The average in investing is like average.
And for those listening, Ren just put 2 thumbs up. So Ren, the final one is one that I think we've spoken about in some form or another plenty of times. But to invest, you don't have to be an investor.
Yes.
Yeah, how good. I remember speaking to one of my favorite guests we've ever had. And if you haven't listened, go over and check out both You're in Good Company, she was on You're in Good Company, and Equity Mates Investing Podcast, Emma Fisher. We were lucky enough. She works for Airlie Funds, and she made it very clear that you don't need a degree in finance. In fact, I'm pretty sure she said if she could tell her younger self something, or advice to her younger self, it would be that you don't need a finance degree, something along those lines to be a successful investor.
There you go.
And I was just like, wow, well, if she can do it, so can we.
Yeah.
So what's your take on this one?
I'm just now thinking that we can achieve Emma Fisher levels of success.
Well, maybe.
Look, I think if you asked 20-year-old Bryson Wren what it took to be an investor, we probably would have started with, Warren Buffett sitting in his room reading 500 pages a day. At the very least, we would have thought about some investment bankers in Sydney and chucked on some RM Williams and chinos and...
That's what we wear.
Yeah. We're in finance. Well, we're not. We're finance adjacent.
We're peripherals.
We're finance adjacent. But everyone has these ideas of what it takes to be an investor, both in terms of mainly in terms of the work that you have to do. Like I have to read so much, and I guess I have to subscribe to the AFR, and I have to
get the calculator out.
Yeah. And I think, while we were at uni, the idea that we could have just put a little bit of money into the market and then gone on with our lives, probably would have led to an even more fun uni experience.
Yeah, big time.
Yeah. I would have cancelled the AFR subscription. Probably wouldn't
I was surprised you had one at uni.
Probably wouldn't have made the mistake and invested in Slater and Gordon.
True.
I don't know if we actually had one, or is that Chrome plugin? Do you remember that?
Yeah, I was going to say, because isn't it the most expensive paper in the world? It was the Chrome plugin, now that I think about it, which was awesome.
No longer exists. AFR, if you're listening, we now do subscribe.
Yeah. we do. But it was so much, I agree, Ren. It was so much, there was a lot of kind of noise at the time and in our heads of what it would take to be an investor. And I think being able to have blocked that out earlier and understood that you don't need all of that stuff, you don't need to understand all the ratios, you don't need to feel like you have that strategy in place, would have helped a lot.
Yeah. We wouldn't have been downloading PDFs of company reports and trying to read through them and make heads or tails.
What are we doing?
What are we doing now?
I don't know. Not that's for sure.
And we celebrate an investor like Buffett who reads 500 pages a day, and I think we should celebrate the real investors, so the next generation of 21-year-old Bryces and Wrens aren't wasting their unis trying to read annual reports.
No, they're doing 500 TikToks a day.
True. The investors that take a percentage of their salary and dollar cost average in, or add 4% to their super above what their employer pays, and then gets on with their day. That's just as much investing as Warren Buffett is. And so I think it's an important learning that investing is a skill, like driving is a skill, and it can fit into your life however you want it to, but it's just an important skill to have. And
crucial life skill, I would say.
Just as important as driving. And just as people get ridiculed.
Debatable.
Which is more important?
Investing.
Oh, wow. Okay,
yeah,
okay.
I don't think you're going to need to know how to drive in the future.
Okay. I mean, sure.
Driving,
all right, we'll say,
if you had to choose one or the other, I think driving's not going to set you up for life.
I feel like this is the stuff we clip and then we put on social media.
Yeah.
Put it on TikTok and then see what people say.
Driving or investing, which is more important.
Yeah. I'm going to look. Let's compromise and say it is at least as important. Maybe in the future it will be more important.
Investing.
Yeah.
Yeah. Well, sure. Let's sure, we'll meet in the middle.
But yeah, look, I think looking back, we could have really saved ourselves some time and some angst, some noise and some mistakes.
Yeah. If
we had just understood what you needed to know, and then what was us trying to pretend to be something that we weren't.
Yeah, and I think all three of them, you don't have to pick a side. A lot of noise in picking sides. The difference between right and wrong isn't the difference between making and losing money. And to invest, you don't have to be an investor. The industry for a long time has constantly thrown a lot of jargon and noise and stuff out there. One could, I guess, cynically say to confuse the mums and dads and the Wrens and Bryces so that we would give our money to professionals. And
some could say
that's not what we're saying. That's not what we're saying.
Some could
but
say.
Some could say that. And there's nothing wrong with giving money to the professionals but Look.
No, in fact, there's a lot right with giving money to professionals, but there's even more right with having the investing skills to ask the hard questions,
right questions
and to know what the professionals are doing.
Exactly.
Because we've heard some horror stories. And so whether you should, if it's right for you, you should see a professional, but you should go in armed with the knowledge that 21-year-old Bryson Wren did not have.
That's it. So I hope we've been able to, clarify a couple of misunderstandings or points that we felt sort of confused us or made us more nervous and overwhelmed than we should have been.
The thing was, though, at the time, we weren't really nervous.
True.
And we didn't think we were overwhelmed. We just didn't realise what we didn't know.
True. It could have been smoother sailing. I would have lost less money.
Oh, 100%.
Yeah.
I would have lost so much less money.
But there's also nothing wrong with losing money. You're going to lose money.
Better to lose money then, I think, because we would have probably pissed that money away some other way.
True. Let's not talk about how. But anyway, if you have some key takeaways or lessons that you've learnt, we'd love to hear them. Send it in to our email, contact@equitymates.com. And as we said at the top of the show, there's plenty of content at Equity Mates Media. The Dive Daily is our 3 times a week business news show. You're in good company. CVE, Comedian v Economist, Talk Money to Me. Get Started Investing is this one, of course. Equity Mates Investing Podcast and Meet Pay Love. Go and check them out. Crypto Curious as well. So plenty going on. Hit us up, equitymates.com as well. You can catch all the transcripts, videos of all the episodes that we do. But Ren, great to chat, and we can pick it up next week.
Sounds good.